good day, traders. Happy Friday to all, and certainly what a week it's been for those people who have been long and bullish the US dollar. You know, it's been a fantastic trade there. How much more juice is in that long US dollar trade before we start seeing a response from the Federal Reserve? Certainly we expect something fairly soon from Donald Trump on the Twitter sphere, but how much more before inflation expectations start rolling over significantly and the Federal Reserve become more concerned about this wrecking ball that is the US dollar? But for now, we stay long, we stay optimistic and stay positive. If we go to the boards and have a look at how the US dollar's performed, you can see against this basket of currencies, these major currencies, the dollar's gained 2.3% against the Brazilian real, it's gained 2% against the Japanese yen. You go into sort of the high beta currencies there, the Aussie, the Mex, the New Zealand dollar has those sort of commodity characteristics around them, you know, down 1.5% to 1.6%. You know, the Korean won, always something that I like to look at it as a global proxy of a risk, and certainly what's happening in Asia there. You know, the Korean won down 2.3%. It's been the CAD which has been the superstar currency outside of the US dollar. We've seen that better bid coming through in the oil price, and certainly that correlation, the 20-day rolling correlation between crude prices and dollar CAD has really ramped up as well in terms of that inverse correlation there. So, you know, the CAD really feeding off that short covering rally that we've been seeing in the WTI price. And actually, we've only seen the Swiss franc losing out 17 basis points against the US dollar. So it tells me if I want a safe haven currency at the moment, I'm going to the Swissy, I'm going to the US dollar. If we do see implied volatility in financial markets really ramp up, where do I want to be? I want to be in the US dollar. I want to be in the Swiss franc. I don't want to be in yen. The market's told us that safe haven appeal of the yen has dissipated. You want to be as far away from China as possible. You want to be so far away from Asia with this slowdown we're likely to see in this February data flow into the March data flow. The US in that situation is the least dirty t-shirt. It's the best house in a shabby neighborhood. You know, a lot of savings capital is making its way into the US at the moment. You know, it's that best place to be at the moment, and that's what we're seeing there. So, what do you want a safe haven currency? You go to the Swissy, you go to the dollar. Yeah, the Japanese yen, dollar yen, you know, it's down 2%, but it's broken away quite firmly from one of its natural or long-term correlations, which is the US Treasury market. When we see yields moving higher, we tend to see dollar yen moving higher, and when we see US Treasury yields moving lower, that disincentivizes Japanese investment funds to go into that jurisdiction. And the fact is you've got the 10-year US Treasury now sitting at just above 1%, 1.5%. If you inflation adjust that and look at it on what we call a real basis, we've got those sitting at negative 12 basis points. So dollar yen is just not working at all in line with what we've been seeing in the Treasury market. In fact, if you have a look at the daily chart of dollar yen at the moment, we're eyeing a move into 112.40, which is that recent swing high. That's also the double bottom neckline. So if we get a breakthrough there, a closing break, and a convincing one as well, you know, you could be looking for significant upside in dollar yen on that technical target, perhaps even as high as 120 based on that pattern there. But, you know, dollar yen has been moving up. It's been moving away from that natural target there. So the dollar's been one-way traffic against major currencies. Have a look at it against EM, and this is where we should be a little bit more worried, because you can, again, you've got the Brazilian real. Have a look at what's been going on against things like the Rand, down pretty hard. The one we talked about there. But yeah, there's not really any currencies in emerging markets which are actually finding any kind of buyers there against the US dollar. I really like to have a look at what's happening in dollar CNH, the offshore yuan. We've seen a move back up to 704. Can we get back into 710? What does this mean? It means with the reduction in purchasing power for Chinese importers, there's really very, very limited chance that we're going to see $40 billion worth of agricultural products being bought as part of that phase one agreement when they're losing purchasing power at a time when their economy is slowing down. So it does seem to me that the prospect of them buying this fairly aggressive, this punchy number of agricultural products from the US is dissipating. What are the US going to do as a ramifications? But certainly we can see that the US dollar is gaining over the last 5 days against all of these EM currencies. And have a look at this chart for me, because it's really, really key. This US dollar has been one-way traffic. You've seen the US dollar index, the USDX on MT4, MT5, and you can see that's been moving up to the highest level since 2017. Have a look at the trade-weighted dollar. I've used the Deutsche trade-weighted index, again, the highest level since 2017. The blue line in the top pane you can see is five-year break-even. So in layman's terms, this is 5-year inflation expectations in the US starting in 5 years' time. You can trade this if you're a fixed income specialist. You can get hold of this, and it's a way of expressing a view on where you see inflation expectations. expectations. And the Fed and other central banks are so importantly cognizant of what inflation expectations can do. There is this feedback loop between inflation expectations and underlying inflation. If you believe that a car is going to be cheaper in 6 months' time, you're going to hold off from buying it, and that breeds downside in price. So inflation expectations are absolutely key, and you can see now as this dollar is moving up, and that rate of change, which we can see on the bottom pane, is picking up as well. It's very key for central banks. They do not want a one-way traffic move into a currency, especially when that rate of change is picking up. But now we're seeing inflation expectations push into this congestion zone around 165. If it breaks through there to the downside and those rate of change in terms of inflation expectations move lower, that will see a response from the Federal Reserve, in my opinion. They will turn more dovish at the margin. At the moment, they're a little bit sort of neutral on what's happening. They're fairly comfortable with what they're seeing there. And I think, if that accelerates the downside, there will be a dovish reaction from the Federal Reserve. So that chart is absolutely key. We're keeping our eye this week and this coming week on inflation expectations. If you have a look at what's coming out throughout the week, now going to the US, there's not really a lot that I'm genuinely concerned about. We've got consumer confidence numbers. We've got Q4 GDP revisions up to 2.2%. We've got core PCE or PCE deflator, which is expected to tick up to 1.7%. On Wednesday, we've got Richard Clarida, the Vice Chair, speaking from the Federal Reserve. What will he say? He's been fairly neutral. He's been fairly happy with what he's been seeing at the moment. But will he say something about the dollar and what it's going to be doing for inflation expectations? That's something we're looking at very closely. As I say, we're keeping our eye on what's happening in Nevada. Will we see a response? Bernie Sanders is polling pretty well at the moment. If we go into China, I think the event risk in China is going to be absolutely key. We go into the back end of the week and we're focusing on what's happening in the February data series in China. What we want to have a look at is how price action goes as we go into the weekend, because on Saturday we get the PMI numbers and the service sector number. Now that's a gapping risk for markets as we go next week into the weekend. And the numbers are going to be poor. The last print that we had on manufacturing came out at 50 on that diffusion index, which was just on that sort of boom-bust level that we've been seeing. I wouldn't be surprised if that came out closer towards 45. There's only a couple of economists so far who have been brave enough to give us their calls, and they're sitting around sort of 46. So we are going to see that pace of a bit of a slowdown there in manufacturing. That's not going to shock at all. But I think, it wouldn't be surprised if we saw a number below 46. The service number, which last month came out at 54, so decent pace of expansion in services in China. If that comes below 50, then on Monday morning, I wouldn't be surprised if we saw a bit of a gapping move in the Aussie dollar and also things like copper and anything leveraged to that situation. In Canada, we've got GDP numbers. I think, market's expecting that to come out around 1.8% or so. New Zealand, we've got trade balance. But for me, we're looking at what's happening in this Asia data points. We're keeping our eye on what's happening in that China manufacturing numbers, the service sector. We've got Singapore industrial production numbers. We've got Taiwan industrial production numbers. They're both of them expected to be quite weak. Again, what will happen there? What will that do to incentivize these dollar inflows as well? So I think that's going to be absolutely key as we go through that week. Keep an eye on your positions, because we want to understand that we are going into that weekend knowing that there's a major event risk as well. We're focused on what's happening in the Australian data series as well. We've got Q4 GDP coming out on the 4th of March. We're going to start getting those partials that feed into that GDP calculation. This coming week, we're going to have private capital expenditure numbers. Markets expecting that to be at 0.7%, and that therefore hold a decent contribution towards those GDP numbers there. But Australian dollars has really been focused much more closely, again, on being a proxy, a way of hedging out some of that downside risk that we're expecting in Asian economics. The Australian dollar just can't catch a friend, and that poor unemployment number in terms of the absolute unemployment rate, the underemployment rate that we've been seeing coming out at 8.6%, has brought the domestic data back onto the fold. You've got that double-edged sword playing against Australia. Poor economic data domestically, and obviously being used as a hedge against what we've been seeing in Asia as well. Now we've got that private sector capital expenditures numbers coming out. Will that be a volatility event? I'm not so sure, but we're going to start getting those Q4 GDP contributions playing through again. But for me, we sell rallies in the Australian dollar. Now have a look at the implied volatility matrix that we've got here. On the left-hand side, as always, we've looked at what a lot of you guys will be looking at, which is of course realised volatility. I'm more concerned about what the market's seeing in terms of implied vol, and we've got 1 week implied vol here in the middle. We've got Aussie yen, once again, as it always is, 9.62%, top of the pile there. That's where you go for move. and that volatility sits 50 percentile as well. So if we look at where that 9.6% in 1 week implied volatility sits in that 12-month range, it sits mid-range. So it has crept up a little bit, but it's not at levels where I'm expecting fireworks, or the market's expecting fireworks. That 9.62% equals a move of 85 pips either side of current spot price. So that puts a range on Aussie yen of 74.95 down to 73.25. The market's saying it should be contained within that range with a 68.2% level of confidence. You've got Aussie dollar and Kiwi dollar. That's moved up a little bit from those sort of 20 percentiles up into sort of 40 percentiles, but we've got that sitting above 7% for the pair there. Both pairs actually quite ironically are looking for about a 55 point move in Aussie dollar and Kiwi dollar, up or down. So it gives a range in Aussie dollar of 66.67, 65.57 with a 68.2 level of confidence. We've seen obviously a big pickup in dollar yen flow, and the realised volatility in terms of the 5-day ITR has moved up to 89 points, 89 pips. Bollinger Bands have started widening. You can see that Bollinger Bands sit in that fairly punchy range, about 400 points or so. But what does it mean for implied vol? Well, 6.77 has picked up a little bit. That was in sort of the doldrums. And implied volatility in dollar yen now sitting at 52nd percentile. So mid-range, that was much lower than that. And that gives us a move of 90 pips over the coming weeks. So the market's looked at the US data. It's had a look at the weakening of the yen, the volatility that's taken from realised. And they've said that perhaps with a 68.2% level of confidence that we could push up to 112.96. The downside's probably limited down to 111.16. So a bit of range expansion expected from dollar yen. I don't think that will surprise anyone, given we have seen realised moving up a little bit as well. And then you've got euro dollar. The market's expecting a 62-point move up or down based on that straddle pricing, taking it to a range of 108.48, 107.24. In terms of the JP Morgan global effects, when we aggregate this volatility structure, it's still very low at 18 percentile at 5.74%. But you are getting these kind of pockets of moves that you're seeing playing through. Now, have a look at euro dollar in terms of the 3-month risk reversals. I think this is really interesting. It tells you a lot about semantics. What are people doing in terms of paying up for volatility? Well, what we're doing with the risk reversals is we're looking at 3-month euro dollar call optionality relative to that of put volatility. Now we're seeing that number at negative spot 22. That tells me that 3-month implied volatility for puts, which give you that downside protection or that downside move, is trading at 0.22 vols premium to calls. And that was at one stage, you know, the market was looking for upside and paying up for that call optionality. That's obviously had a big move down. We're now at the lowest level since September. That tells me that the option that people have been paying up for that put volatility. They've been big demands for those sort of 25 delta put volatility. Now, in terms of what we've been seeing in the rates market, I've got a more extended rates table than what we'd usually look at. The second column, you can see what's priced in for the next meeting. Bank of Canada, for example, on the next central bank meeting now, they've got a 17% chance that we're going to get a rate cut, the RBA 5%. So it's quite low, but then we go into the second meeting and the next meeting after that in June, or May in the case of the Reserve Bank. And we're starting to get to a point now where the market's saying, if we don't see a cut coming through in April, there's a pretty good chance that those meetings around June are going to be live. Now, if you go out to the far right column, you can see what's being priced there. The Federal Reserve, the market's nearly pricing in 2 rate cuts. Now, I believe if those inflation expectations move to the downside, if we see dollar CNH moving up more aggressively, interest rate expectations are going to be moving up. Now, the question is, if we do see the market once again, similar to what we saw in 2018, where we see those interest rate markets becoming quite lively, we see the expectations of central bank action once again quite extended, and the central banks do not acknowledge what the market's pricing and they don't share the same journey, that's when you're going to see much higher volatility in financial markets. In 2018, the markets had discounted a significant easing path, not just from the Fed, but other central banks as well. The central banks were not meeting the markets forced them to cut rates, and now we saw that big pivot coming through. Are we getting into a regime where we're going to see that same dynamic playing through? This Asian data that we're going to be seeing, Singapore, Taiwan industrial production numbers, the data coming out of the US, out of China, the ISM manufacturers in the US, which comes out early March. If that comes out on the weak side, markets price in higher rate expectations, the Fed and other central banks don't share that same journey, you are going to see markets tumble, you are going to see equities coming under pressure. Breadth has been very poor in the equity markets and implied volatility is going to ramp up. We're not there yet, but the dollar will set the scene here. So have a good week all.